We're at our next to last session, very important session, towards a monetary policy strategy. We have four excellent speakers, two currents, two formers. And what more could we ask for? We'll have a good discussion. Anyway, we're going to start with Jim Bullard, as president of the St. Louis Federal Reserve Bank, Phil Jefferson, who's, I can't say too much, I guess, is governor of the Federal Reserve Board, and Jeff Lacker and Charlie Plosser. So we'll go in that order. So take it away, Jim.
Okay, thanks very much, and thanks for having me today. I'm happy to talk about many of the themes have already been discussed today. This is called the Monetary Fiscal Policy Mix, the Central Bank Strategy. So I will emphasize the fiscal elements that have been talked about in the way I like to look at them anyway, in these slides. So the basic outline of this talk is that the pandemic fiscal monetary response created too much inflation. And I think that's something we can elaborate on here. And to eliminate this excess inflation, the fiscal monetary response has to be countered. And I'm going to argue that that's actually happening as we speak. In particular, I'll argue that the fiscal stimulus is receding and that the monetary policy stance has been adjusted rapidly in the last year to better align with what I would call traditional central bank strategy, something more like Taylor rule. Accordingly, I think there's prospects for continued disinflation in the US that are reasonably good, though not guaranteed. I have to be sure to say that. So let's talk about the fiscal monetary response as a starting point here. I think it's been alluded to here that you may want to think in terms of Sargent when you're thinking about this topic. Think of the pandemic as a global war that induced large-scale deficit spending combined with accommodative monetary policy. And I would remind all of you that the spirit of the pandemic response was to err on the side of doing too much as opposed to too little to respond to the pandemic. The idea was that you didn't want the pandemic to also damage the economy and leave you underproducing for 10 years or something like that. So we wanted to do too much rather than too little. But you could also think of that as risking a high inflation regime, as the monetary authority is not offsetting the huge fiscal impulse that's occurring, that's unleashed by the fiscal authority. So I think it's also important to think of government spending generally in terms of what it's used for. And here it was used for transfer payments to disrupted workers and businesses. That shows up as a sharp increase in personal saving relative to trend, which I'm going to put in the chart here in just a moment. And I'd stress that fiscal action of this magnitude was unprecedented in US post-war macroeconomics. So if you're trying to map what has happened after the pandemic into previous recessions or the post-war era, or even to some extent across countries in the post-war era, you're probably going to miss the mark because this one had this huge fiscal impulse associated with it. And meanwhile, the monetary policy reaction to the pandemic was to lower the policy rate sharply, which was accommodating the deficit spending. So this sounds like the kinds of things that happen during wartime. There's some kind of social emergency, like a war. The government goes out and borrows a lot to finance the war. The central bank is asked to accommodate that with low interest rates. We know that that combination has caused inflation in many different times and places across macroeconomic history. So it's not surprising, really, that we got substantial inflation out of that combination of policies. So here's the picture. This is the monetary fiscal response to the pandemic. This goes from 2016 on the left over out to the present on the right. The gold line is the effective federal funds rate on the right-hand graph, right-hand scale. The blue line is the personal savings rate relative to a pre-pandemic trend, which is the dotted blue line there. And then the pandemic itself is, the pandemic recession itself is the gray area in the middle. So you can see as the pandemic comes on, you get this very sharp response, both of fiscal and monetary policy. The blue line shoots up, and simultaneously the gold line goes down to zero. So this is the nature of this particular episode. It was very sudden, very sharp reaction. You can see on the left-hand scale that you're talking hundreds of billions of dollars every time the blue line peaks. And the blue line stays above the trend line for many months here, more than a year, and then goes below the trend, and I'll talk about that in just a moment. So that's the monetary fiscal response. You should think of that like a similar response to a war. We did have the paper by George Hall and Tom Sargent here last year talking about the financing of 3 global wars, World War I, World War II, and the pandemic. So it led to substantial inflation, and I've just brought in the Atlanta Fed's inflation tracker here, maybe just to make some side points as well as just pointing out that we got a lot of inflation. These are measures of underlying inflation in the Atlanta Fed's chart here, which they maintain on their website. And all the measures of underlying inflation. So you're kind of kicking out extremes, you're throwing out food and energy in various ways. These are all these different measures of inflation. And this shows, the middle column shows what the inflation rate was on a 12-month basis in April of 22. And the last column shows where we are today on all these measures. So you can see, I think it's kind of interesting that 5 of these 9 are actually higher today than they were a year ago. Sort of belies the idea that we've got inflation on a clear disinflationary path. You look at core PCE inflation there, it was 5% a year ago, now 4.6%. That's the committee's favorite measure. But some of these other measures, the San Francisco Fed cyclical core PCE, up substantially from where it was last year. Cleveland Fed median CPI up substantially from where it was last year. And Atlanta Fed sticky CPI up substantially from where it was last year. So it's not, if you had a really good disinflation going in the US economy, all these measures would be down. All 9 of them would be down from where they were a year ago. That's not happening so far. But our favorite measure is down slightly. Bell's Fed trim mean, which is my favorite measure, is actually up from where it was a year ago, about 80 basis points. So what has to happen if you have a major social upheaval, you have a big fiscal impulse, you have a monetary accommodation of that impulse? What has to happen? Well, you have to switch back to the pre-war policy. So we want to go to the pre-pandemic monetary fiscal regime that featured inflation near target. So whatever was going on pre-pandemic, it seemed to be working a lot better than what went on during the pandemic with respect to inflation. So is such a switch occurring? And I'm going to argue that it is. The fiscal stimulus in particular have been fading as the personal saving is now below the pre-pandemic trend line. It's not quite faded completely because the area above the trend line on the chart is still more than 400 billion larger than the area below the trend line. So this is the same picture we had point before. Again, you're talking about a very large fiscal program here, directly more or less to households. That's what this is saying. The green area, about 2.1 trillion excess savings. of which the red part there, 1.6, has been burned off, but that still leaves you with $500 billion to go. So there's still something here in this fiscal stimulus, but it's certainly fading compared to where it was, and it does take quite a while. We're out 3 years here, and it's not quite totally extinguished. But I think this is fading. And then on the monetary policy side, we would have to switch to a sufficiently restrictive monetary policy. I've got a bunch of slides about that. So when you think of Sargent, the ends of four big inflations, which I think is one of the best papers of the 20th century in macroeconomics, in those papers, in the four hyperinflationary economies post-World War I, the inflation ended on the day that the fiscal reform occurred jointly with the monetary reform. So it's a particularly dramatic example of the credible regime change all happening right at the same time. We don't have that. Not everything isn't happening quite all at once on the same day, but it is happening, and a big part of that was U.S. monetary policy in 2022, which has moved us in much better position than we were 1 year ago when we met here at Stanford. So my approach to this is to have a Taylor-type monetary policy rule with generous assumptions, which will give us a minimal recommended value for the policy rate given current macroeconomic conditions. So the generous assumptions means that it's going to favor assumptions that would favor a lower policy rate. If we're not quite so generous in our assumptions about our Taylor-type rule, we'll get a higher recommended policy rate. That'll give us an upper bound. And then there will be a zone in between the lower bound and the upper bound. We're going to see whether we're in that zone or not. It's going to turn out that we are. I'm not going to talk about balance sheet policy in this talk, but I have talked about that elsewhere. Why do we like Taylor rules? Partly because John's sitting right here.
What can I do?
I just put this slide in here. I think they're particularly useful when you're away from the zero bound and you have an inflation issue. I think they've been used around the world to allow central banks to hit a credible inflation target. So also they've been evaluated in a large literature and been argued, as was said this morning, have been argued to characterize close to optimal policy in commonly used macro models. I do want to stress that Taylor rules also address the long and variable lags argument. You have your model has all kinds of lag structures and all kinds of things going into it. You put your Taylor type rule in and you optimize the coefficients in that Taylor rule for that particular model. That's telling you where the policy rate should be at each date. And so it's taking into account all the leads and lags that are going on inside the model. So I think that there's been confusion over this issue about long and variable lags. The whole idea is that it's a linear feedback rule based on the state of the economy as it is today. And so you're already taking this into account. So I don't think it's fair to say, I don't have to be as high as you think I have to be today because later on I'll be able to lower the rate to where I am today, so therefore I don't have to do anything. I think those are convoluted arguments. So I also think Taylor rules help you center the debate. They help you think about, okay, well, why do you think a certain policy rate is the right one? Okay, I'm going to put together the list of ingredients for my Taylor rule, then we can argue about whether those are the right things or not. And we're going to do that right here. This is the Taylor rule specification I'm going to use. It does have a max operator here to keep us from going below zero, and a very standard looking Taylor rule based only on the output gap. The output gap term is currently positive, so we're going to take the minimum of the output gap and zero, so we're just going to zero that part out. Why are we doing that? The FOMC's framework states that the policy decisions must be informed by assessments of shortfalls of employment from the maximum level. So if the labor market's working fairly well, we're not going to take too much signal from that with a flat Phillips curve. Might as well just zero that part out, allow the labor market to be performing well. We're not going to have a higher policy rate just because of that. So the generous rule is going to have three assumptions in it. We're going to measure the inflation gap using the Dallas Fed trim mean PC inflation rate, which is one of the ones that's relatively low compared to some of the other measures that we could use. We're going to use an approximate pre-pandemic value for the real interest rate of a shocking minus 50 basis points. But I'm going to argue that that one fits the data better pre-pandemic. And then we'll use a relatively low value of 1.25 for the parameter describing the reaction of the policymaker to deviations of inflation from target. Then we want a less generous Taylor rule where we don't make those assumptions quite as nicely to give lower policy rate recommendations. So for this, we'll use core PC inflation as the inflation measure. We'll use a higher value for the real interest rate, one that would come from Holstein Lowick Williams of about plus 50 basis points or so. And then a larger parameter, 1.5, which is closer to the literature to describe the reaction to inflation deviations. So is the current policy rate, which has just been moved above 5%, is that sufficiently restrictive? So the chart is going to say that a couple things, which I'll emphasize when I get to the chart, but first of all, this idea that the policy settings were about right pre-pandemic. So pre-pandemic, you had output growing kind of close to potential. You had inflation a little bit under target, and you had no projections of anything changing. So you could argue that you were on the balanced growth path pre-pandemic. So that's a good kind of benchmark to anchor what we're thinking about here. Monetary policy clearly behind the curve last year at this time, which will show in the picture. But now we're at the low end of what is arguably sufficiently restrictive given current macroeconomic conditions. And finally, the zone itself can move in reaction to incoming data. So here's the picture. So the zone is the gray area, the upper bound, the little dotted gold line, the more dashed gold line is the lower bound with the generous assumptions. This goes back to 2019, pre-pandemic. So first of all, you can see, and the blue line is the actual policy rate. So you can see, first of all, that pre-pandemic, we were actually in this zone. So this is a way to anchor how we're thinking about this, that policy was pretty good at that point, seemed to be about right according to this calculation. And so it makes sense. The pandemic comes along, of course we go down to zero, but the zone you can see moves up in 2021, as has just been discussed at length, whereas the blue line does not move up till 2022. So clearly behind the curve with respect to the policy rate. Last year at this time, and I did talk about this picture last year, but now we've come up dramatically during 2022, and the committee did work very hard on monetary policy during the year. 475 basis point increases, unprecedented in the post-war era. I also think we communicated ahead of time that we were going to move, and we were going to move fairly quickly. I would say that most entities around the country adjusted pretty rapidly and pretty well to the increase in interest rates because they knew it was coming. I don't think you can expect every single entity to adjust perfectly to increase in policy rate of that magnitude, but I do think the communication was forthright and direct. So now you get over to the right-hand part of this chart, median projection for 2023 for the March SEP, 5.125%. Looks like it'll be in this zone once this zone gets updated to the right in this chart. So Now, maybe the bad news for the hawks in the room here is you're barely in this zone. I made a lot of generous assumptions, but I think you've moved to a point where we could consider this sufficiently restrictive. And in conjunction with the fiscal part of the policy fading, it looks like we're making the switch to the pre-pandemic policy regime. On policy inertia, there's no inertia in this policy rule. I regard the inertia to be a judgment made by the committee about how fast to go in a particular situation. You could always put a ton of weight on the inertia part of the rule, and it would tell you to adjust extremely slowly. You could put no inertia at all, and it would tell you to adjust immediately. So I think that part is a judgment call. The committee did move quite rapidly in 2022, which I think was a good thing, and gives us the best chance of getting inflation back down to target relatively quickly. So now we have prospects for disinflation. So far, core PC inflation has declined only modestly from the peak levels observed last year. However, I do think that there are encouraging signs that the switch from the fiscal policy mix during the pandemic to the pre-pandemic fiscal monetary policy mix is working, and I would take market-based inflation expectations as that signal. Those expectations were near 2% in the first quarter of 2021 when there was no inflation and no inflation predicted or expected by markets. After, I think there was a period of uncertainty in markets whether the Fed would actually get its act together and whether this switch to a different fiscal policy would occur. But now, after two years or so, these expectations have returned to levels consistent with 2% inflation. So this is the picture that I like on this. This goes back to January of 2021 and out to the present. In January of 2021, there was no measured inflation and no one was expecting inflation. And you could see the 2-year, the 5-year, and the 5-year forward inflation expectations all slightly above 2%, which is considered consistent with the 2% inflation target on PCE inflation. Then in the middle of this picture, things blow up some, and there is, I think, points at which it wasn't clear, especially in the first half of 2022, in the middle of the picture, where it appeared like expectations might run out of control, and therefore inflation in the US might run out of control. But the committee took very sharp action during the summer of 2022, especially, and you can see expectations came back down. And now on the right-hand part of this chart, we're back to levels that are consistent with the 2% inflation target on PC inflation. So this I find very encouraging. The committee has taken sufficient action to keep expectations under control. And prospects are that actual inflation will follow behind inflation expectations and return to the 2% target. So I'll stop there. The pandemic fiscal monetary response created too much inflation. It's like a war. Historically speaking, we know that this sort of combination creates a lot of inflation across many times and places. To eliminate that, you have to return to the pre-war or the pre-pandemic monetary and fiscal policy. I think this is happening. The fiscal policy on the dimension that it matters for this issue is receding, and monetary policy has been adjusted rapidly. And so I think the prospects for continued disinflation are pretty good. So thanks very much.
Thank you. Thank you.
Good afternoon, everyone. Thank you to the organizers for inviting me to speak. It is a pleasure to be here. I welcome hearing diverse views on how best to conduct monetary policy, and this conference is certainly providing an invigorating debate on that topic. Before I begin, I want to address quickly some news from this morning. I am deeply honored by the trust President Biden and Vice President Harris have shown me with the nomination to be the next vice chair of the board. I am humbled by this. I am humbled by this extraordinary opportunity and thankful to my colleagues, friends, and family for their support. And now I will turn back to our regularly scheduled programming with a standard reminder that the views I will express today are my own and are not necessarily those of my colleagues in the Federal Reserve System. The title of this conference, How to Get Back on Track, a Policy Conference, is potent. Its intent and ambiguity are striking. First, the title presupposes that U.S. monetary policy is currently on the wrong track. Second, the webpage for this conference advances a puzzling definition of the phrase on track. How so? According to the Hoover webpage, and I'm quoting, a key goal of the conference is to examine how to get back on track, and thereby how to reduce the inflation rate without slowing down economic growth, close quote. As this audience knows, there are macroeconomic models that permit disinflation with no slowdown in economic growth. But the assumptions underlying these models are very strong. It's not clear, at least to me, why such a strict metric would be used to assess real-world monetary policy making. Third, the definition of on track in the title contrasts with a more commonplace definition, such as, quoting again, achieving or doing what is necessary or expected, close quote, as offered by a standard reference such as the Merriam-Webster Dictionary. My view is that this commonplace definition provides a more practical lens through which to assess real-world policy making. Against this semantic backdrop, I will begin my remarks with my perspective on the current inflation and economic situation. Then I will consider credit conditions in response to the recent bank stress events. Next, I will offer some normative thoughts about strategic monetary policy making in highly uncertain environments. Finally, I will argue that if you are willing to widen your lens to include a more commonplace definition, then it is possible to conclude that current monetary policy is, in fact, on track. Current inflation is still high. Figure 1 illustrates this point. Personal consumption expenditure inflation, the black line, stands at 4.2%, and core PCE inflation, the red line, stands at 4.6% for year-end March 2023. Overall, news on inflation so far this year has been mixed. The good news is that food and energy prices both fell in March, and total PCE inflation slowed to 4.2% from 5% in February. Since peaking last June, inflation has declined about 2.75 percentage points, with nearly all the step down explained by falling energy prices and slowing food prices. The bad news is that there has been little progress on core inflation. To understand why, I find it useful to separately analyze three large categories that together make up core PCE. Goods excluding food and energy, the red line in figure 2, housing services, the black line, and services excluding housing and energy, the blue dashed line. The drivers of inflation in each of these sectors differ somewhat, and understanding the different causes and how they affect the different components can help predict the future course of inflation. Core goods inflation, the red line in Figure 2, has come down since its peak of 7.6% in February of 2022. But the most recent news has been discouraging. Outside of used motor vehicle prices, which fell unexpectedly in March, disinflation in core goods prices is occurring at a slower pace than expected. Disinflation, supply and demand imbalances in the goods sector seem to be resolving less quickly than expected. Core housing services inflation, the black line in Figure 2, surged over the past couple of years as demand in the housing sector underwent a major shift during the pandemic. The latest monthly readings have started to slow, though that is not yet evident in the 12-month changes shown in Figure 2. The recent slowing was presaged by a flattening out of rents on new leases to new tenants since the middle of last year. In contrast, core services, including housing inflation, the blue dashed line in Figure 2, has not shown much sign of slowing. Turning to labor markets, the April 2023 employment report data continue to point to a strong labor market amid improvements in labor supply, with the prime age labor force participation rate exceeding its pre-pandemic level. Wage growth has continued to run ahead of the pace consistent with 2% inflation and current trends in productivity growth. Wage gains are welcome as long as they are consistent with price stability. Over the 12 months ending in March 2023, the Employment Cost Index for total hourly compensation for private sector workers rose 4.8%, down only a little from its peak of 5.5% last June. Despite strong growth in consumption spending, gross domestic product grew modestly at an annual rate of 1.1% in the first quarter of 2023, as inventory investment slowed down substantially, similar to the below-trend pace of growth in 2022. Looking ahead, last quarter's growth in consumer spending seems unsustainable. Indeed, after rising very steeply in January 2023, consumer spending ticked down in February and was flat in March. Moreover, I expect slower consumer spending growth over the remainder of the year in response to tight financial conditions, depressed consumer sentiment, greater uncertainty, and declines in overall household wealth and excess savings. The tightening in financial conditions we have seen in response to our monetary policy actions is likely to be augmented by the effects on credit conditions from recent strains in the banking sector. The U.S. banking system is sound and resilient. The Federal Reserve, working with other agencies, has taken decisive actions to protect the U.S. economy. Nevertheless, it is reasonable to expect that recent stress events will lead banks to tighten credit standards further. Even though it is too early to tell, my view is that these incremental credit restraints will have a mild retardant effect on economic growth, because the recent bank failures were isolated and they were addressed swiftly by aggressive macro and microprudential policy actions. Nevertheless, I acknowledge that there is significant uncertainty around the amount of tightening of credit conditions in the coming year in response to the bank stress and the magnitude of the effect that tightening might have on the US economy. Therefore, there is some downside risk that the incremental effect of the credit shock is larger than I expect. The pandemic aftermath, geopolitical instability, and banking sector stress have contributed to a highly uncertain economic environment. Additionally, the numerous post-pandemic surprises in inflation, employment, and economic growth suggest that the underlying structure of the US economy may be in flux. More simply, the data generating process for the post-pandemic US economy is less clear. Due to the proximity of the pandemic and its unprecedented disruptions in economic and social activity, there are currently insufficient post-pandemic data to identify the parameters and stable relationships that characterize the possible new structure of the economy. Given this observation, what is a reasonable monetary policy making strategy? The answer to this question is likely to be different for each monetary policy maker. I want to share with you a few strategic principles that are important to me. First, policymakers should be ready to react to a wide range of economic conditions with respect to inflation, unemployment, economic growth, and financial stability. The unprecedented pandemic shock is a good reminder that under extraordinary circumstances, it will be difficult to formulate precise forecasts in real time. Our dual mandate from Congress is especially helpful here. It provides the foundation for all our policy decisions. Second, policymakers should clearly communicate monetary policy decisions to the public. Our commitment to transparency should be evident to the public, and our monetary policy should be conducted in a way that anchors longer-term inflation expectations. Third, and this is where I'm revealing my passion for econometrics, policymakers should continuously update their priors about how the economy works as new data become available. In other words, it is appropriate to change one's perspective as new facts emerge. In this sense, I am in favor of a Bayesian approach to information processing. While these principles do not constitute a complete monetary policy framework, I think they are useful when thinking about features of such frameworks. By way of concluding, I would like to return to the question of whether current monetary policy is on track, but allow for the wider defining lens of achieving or doing what is necessary or expected. The national unemployment rate was 3.6% in March 2022, when the current monetary policy tightening cycle began. Today, after 500 basis points of tightening of the policy rate, the national unemployment rate stands at a near record low of 3.4%. At its recent peak, total PCE inflation was 7% in June 2022. Currently, it is 4.2% in March 2023. Is inflation still too high? Yes. Has the current disinflation been uneven or slower than any of us would have liked? Yes. But my reading of this evidence is that we are doing what is necessary or expected of us. Furthermore, monetary policy affects the economy and inflation with long and varied lags, and the full effects of our rapid tightening are still likely ahead of us. We are balancing the directives of the dual mandate given to us by the US Congress. This is not an easy task in these uncertain times, but I can assure you that I and my colleagues on the FOMC take it quite seriously and with great humility. It is in this sense that I believe that we are well on track. Thank you.
Thank you, John, for the invitation to participate in this conference, and congratulations on your 30th anniversary. I'll be presenting a modest suggestion to improve monetary policy communications. Our suggestion was also presented at a meeting of the Shadow Open Market Committee last November, and it grew out of discussions last fall with Charlie Plosser, my co-author, friend, former FOMC colleague, and current SOMC colleague. The Fed's conduct of monetary policy has been covered pretty thoroughly today, but the Fed has also, we believe, struggled to communicate effectively. There have been notable instances of market surges, seemingly prompted by Fed statements that had to be walked back with some later subsequent correction. And there appears to be a significant gap between the assessments of market participants and the committee about the likelihood of various funds rate paths. It's not clear that market participants understand what might be required to restore price stability. And to the point of Jim Bullard's chart on expected inflation, longer run, market participants may believe inflation will get to 2%, but it's not clear they understand what it's going to take. In the interest of time, I won't catalog all the fits and starts of Fed communication challenges over the last few years. I'll just highlight the Fed's most recent forward guidance framework. It's built on the phrase sufficiently restrictive, which appeared in the FOMC statements from November of last year through March of this year. As you might expect, Chairman Powell has been asked several times to explain what this phrase means, but I think it's fair to say that his answers have been no more specific than the phrase itself. The most recent FOMC statement dropped this phrase, however, leading naturally to questions at the press conference about whether the committee believed policy was already sufficiently restrictive. Chairman Powell's answer was that they don't yet know. So where would one look for quantitative guidance on what level of interest rates would be sufficiently restrictive to restore price stability? The natural answer is to look to historical evidence from times in which the Fed successfully reduced and contained inflation. As discussed this morning, systemic policy rules, such as those introduced 30 years ago by John Taylor, summarize in a convenient and usable, simple form how interest rate settings varied with incoming data on inflation and unemployment when the Fed was successful at bringing inflation down and containing it. The benefits should be familiar from this morning's discussion. In addition, systematic policy rules have intuitive properties. They respond more than one for one when inflation rises above target, so that real interest rates rise and restrain spending, encourage deferred outlays, and interest rates respond similarly to increases in resource utilization. This is the same thing, defer spending. Moreover, such rules perform well in a wide variety of models. So as we watched policy unfold in the last couple of years, particularly last year, and as we reflected on the communications we heard from the Fed, it occurred to Charlie and me that the Fed could improve communications by making explicit reference to systematic policy rules in its discussions with the public. Policy makers could note that successfully restoring price stability is likely to require policy settings that are broadly in line with times the Fed has succeeded in reducing inflation and keeping it under control. They could cite the prescriptions of a range of policy rules with different parameter values that align with that past behavior. And they could point to a range of policy rules so they avoid placing too much weight on any particular version. They could note how current interest rates compare with a range of prescriptions. And they could point to the FOMC's economic projections that are released after every other meeting and cite what these rules prescribe conditional on the FOMC's projections. They could compare those conditional prescriptions with the FOMC's own projections for the funds rate, and they could show how those conditional rule prescriptions vary with assumptions about future inflation and unemployment. The Fed itself publishes several different rules in its monetary policy report to Congress and on the board's website. And those rules are a routine part, as was noted earlier today, of the briefing materials distributed to participants before every FOMC meeting. And this has been going on for a couple of decades. And handy do-it-yourself policy rule calculators are available online at the Atlanta and Cleveland Federal Reserve Banks. I recommend them to you. We believe that referring to prescriptions of systematic policy rules in the manner we suggest would improve Fed communications. It would provide a better way of conveying how high the committee believes policy rates will need to go to bring inflation down to target. It would have helped particularly last year when the Fed was struggling to get the markets to focus on that as opposed to how big the next move was going to be. And more importantly, it would help people understand how incoming data is likely to affect the path of the policy rate. This strikes us as a better way to convey forward guidance than what the Fed's been using. And linking policy to an objective, evidence-based benchmark would dampen any potential perception that policy might be politically motivated. It should provide a better basis for anchoring inflation expectations. So you look at inflation expectations, we discussed a lot in the last session. Those reflect expectations about the future conduct of the Fed. That is to say, the reaction function underlying the Fed's future behavior. And so explaining that better might be the best way or a better way to anchor inflation expectations than what the Fed does now. So it's like Andy's first doctor says simply 2%, trust us. And Andy's more modern doctor, the second one, he says, well, look, understand a lot of things could happen. Here's how we're likely to react. Here's how we'll treat it. The second doctor, the modern doctor, and this is behind the transformation in the way doctors approach this question, understand that that's a better way to reassure patients than just saying, trust me. So we're convinced this would be a better approach. Now, it's important to separate the use of policy rules and communications from actually adopting the rules. We're not saying that this would require them to mechanically follow any given particular rule or turn policy settings over to a computer. This has always been something of a straw man to distract and deflect attention from constructive ways the Fed could improve clarity by talking about the implications of policy rules. And we're not saying the Fed should never deviate from the recommendations of policy rules. Presumably, the Fed would have some reason for doing so, some reason why this time is different. Things happen. We're not ruling that out. But transparency would obviously be enhanced if the committee shared their rationale for deviating from what is, in actuality, past practice. Why are they deviating from past protocol, putting their cards on the table, as it were? So our suggestion is not about the conduct of policy. It's about how they communicate about it. The conduct of policy is a separate debate. We have our views, and I don't think you'd even need to buy us a drink to find out. Just come up and ask us. So in his remarks, President Bullard demonstrated the type of communication we're talking about. He did this twice last year, once at this conference, I understand, and then in November, exemplary. What's striking about President Bullard's presentation is how rare that is. I know of virtually no other communications from the Fed, speeches, public statements, testimony, that mention the Taylor rule, that reference the Taylor rule and how it connects to current policy. So I want to share some calculations to show how this communication practice might work, what it might look like now. Table 1 shows the prescriptions of 3 representative versions of the Taylor rule through 2025 Q4. The prescriptions for the fourth quarter of 23, 24, and 25 use the FOMC's median projections for inflation and unemployment on the right-hand side of the equation. And those projections are shown in the lower panel. Fourth quarter inflation falls, you'll see, from 4.9 to 3.3, then 2.5, then 2.1. The core PCE inflation falls from 4.7 down to 2.1 over this horizon as well. And inflation's back to 2% in 2025. The unemployment rate, which was 3.4% last month, rises to 4.5% in Q4 this year. The second column from the left, up at the top panel again, shows figures for the first quarter of this year. The funds rate averaged 4.1%, while these 3 policy rules recommended settings of around 7.5%. This gap is pretty large, 3 percentage points, and it's a measure of how far behind the Fed has fallen by waiting so long to raise rates. The third column from the left shows figures for the fourth quarter of this year. The median FOMC projection at the March meeting was for a funds rate averaging 3.1%, essentially where they are now. And the 3 policy rules shown here recommend a funds rate of around 4% then, suggesting that policy will indeed be appropriately tight if the FOMC stands pat. That assessment is predicated, however, on the FOMC's projections that inflation will fall to 3.5%, and the unemployment rate will rise by a full percentage point in the next 6 months, essentially. This highlights an important source of uncertainty about the near-term course of monetary policy. If inflation does fall this year to around the rate the FOMC projects, the current level of the funds rate appears to be sufficiently restrictive to restore price stability. But the current level of the funds rate does not appear to be sufficiently restrictive given current rates of inflation and unemployment. And so it's not obvious what force will bring inflation down to the rates the FOMC predicts for year end. A natural question, therefore, is how the prescriptions of those rules would vary if things didn't turn out quite so well this year. Well, Table 2 shows calculations based on a variation of the FOMC's economic projections in which the disinflation they expect is just delayed a year. We just put it off a year. The changes from the SEP projection in the lower panel are highlighted in bold. Those are the only numbers I've changed. Inflation for this year remains at first quarter rates, 4.9 essentially for headline, 4.7 for core. Inflation then falls to 3.3 and 3.6% respectively for 2024, 1 year later than the FOMC projection. The third and fourth columns of the upper panel showed that these rules prescribe significantly higher levels of the funds rate, around 6 to 6.5% in the fourth quarter of this year. So if we don't get inflation falling down to 3.5%, that's where the funds rate would need to be sufficiently restrictive as judged against the pattern of past protocol. Similarly, Table 3 shows calculations for an alternative scenario in which disinflation occurs 1 year later than the FOMC projects, as in Table 2, plus the job market remains tight, with the unemployment rate remaining 3.5% through Q4 instead of rising to 4.5%. So two simple scenarios. In this one, systematic policy rules prescribe a funds rate of about 7.5%, significantly higher than the current rate. Now, these alternatives are not necessarily forecasts that Charlie and I would write down, but they do strike us as reasonably plausible given the recent data. If the data do come in more consistent with these alternatives than the Fed's more sanguine projections, I think market participants are going to be avidly interested in the implications for monetary policy. Policy rules could provide a natural framework for the Fed to convey a quantitative sense of the likely implications of the the data disappointing them on the high side. On the other side, if the economy weakens and tips into a recession fairly rapidly, systematic policy rules can convey a quantitative sense of how much of a pivot is in store. So let me close with a broader observation before turning it over to my friend Charlie. The Fed has often had, mentioned this morning, an unhealthy attachment to preserving optionality. And that seems to be at the root, in my mind, of their resistance to clear communications in general, in a lot of respects, but to policy rules in particular. So my hope is that the Fed policymakers will see it in their interest to clarify things, just the way Andy's second generation doctors realized it was better for patients to avoid the risk of just shocking them with a treatment plan out of the blue. So this way, the Fed, I think, using policy rules can avoid some of the market surges that they saw last year that seemed to be driven by just untethered swings in rate expectations. And I think they can do this without compromising their own view about policy. We've framed this as a communications strategy, not a policy strategy. So they could move to this without claiming they're adopting the Taylor rule or without compromising their future discretion. It's just a matter of being more forthright. So that concludes my portion of the program. Charlie, do you want to come up?
Thank you. I'm going to try to keep my remarks relatively brief because of the time, but I want to pick up where Jeff left off. What we have and what we proposed in this paper was a modest effort to move the Fed in its communications to a more systematic and transparent strategy for monetary policy. I actually proposed something like this myself when I was at the Fed. In June of 2014, I gave a speech at the Economic Club of New York, which actually proposed something very much like this about how the Fed should incorporate systematic rules into their communication and why it would help. However, I'm going to go a step further now in my brief remarks to talk about what has to happen to get the Fed back on track, so to speak, and to achieve a more systematic and transparent approach to policy. The Fed has resisted steps, obviously, to limit its own discretion, and has for years and years and years and years and years and years and years. And it hasn't made a whole lot of progress in changing that view. So they've resisted this limitation on discretion. But in doing so, they've also limited the ability to hold the Fed accountable and to make it more transparent. So the bigger problem, it seems to me, looms out there, and it's a tough one. It stems from a variety of sources, and I just want to mention two. One is limiting discretion, maintaining discretion partly involves a response to many political pressures that the Fed is under. The Fed is supposed to be independent. I think it is losing that independence and it's deteriorating. And that comes from a couple of aspects of things. One is in 1951, most of you know, the Fed, there was the 51 Accords, which was an agreement between the Treasury and the Fed that the Fed would have independence to determine the size of its balance sheet. It gave the Fed ultimate control over determining the size of its balance sheet. That was a very important step at the time because it broke the Fed away from interest rate pegs that occurred during World War II, pegging long-term government bond rates at a very low level. was a very acrimonious battle at some point, but nonetheless, it happened, and they broke the peg, and the Fed was able to determine its own balance sheet size. But times have changed. What we see now is obviously the Fed can control its balance sheet, but the other dimension under which political pressure can get really applied is now the Fed is heavily engaged in credit policy. Balance sheet policy, when the Fed, in 1951, the Fed's balance sheet was entirely government bonds, long-term government bonds in particular. Over time, that gradually shifted to more short-term, but now the dangers of politicization of the Fed, or one of the dangers, is the use of credit policies to allocate resources across sectors of the economy, across firms, and that has become a much more widely used tool, which I think threatens independence and integrates, in some sense, or makes Fed policy less independent and more subject to control by the Treasury. There's a whole literature on that, much of which I've written about, so I won't elaborate on that, but things are different now, and I think we have to look at independence in a different light. The other point I want to make very briefly is coming up with a monetary policy strategy and the advantage of the Taylor rule, or versions of the Taylor rules. What we know about them is they're empirically based. They have empirical evidence to back them up. They are robust across a very wide range of economic models, and they work pretty well in lots of different environments. I think John made this point earlier this morning. I think that it's important that we understand that, and I think John and maybe Rich referred to Friedman's 69 or 68 presidential address this morning. I'm going to pick another quote from Friedman, from that same, if I can find it right, if I get it right. Oh, I didn't bring it up. All right, anyway, that quote is, we are in danger of asking monetary policy to achieve goals it cannot undertake. We are in danger of asking it to achieve tasks that it is unable to achieve. And in so doing, we are putting at risk the contribution that monetary policy can make. That was a cautionary note to say, be careful of what you ask of central banks. And I think we've lost sight of that caution and that wisdom, and we are now asking monetary policy and central banks to do all sorts of things that they weren't designed to achieve, whether it be in terms of credit policy, whether it be in terms of other aspects. We are asking too much of them. We need to reestablish the limitations, the boundaries, and the constraints on monetary policy if we are to achieve both independence and an effective monetary policy strategy. And I'll just leave it at that. Thank you very much.
Thank you.
Jim, your piece was about monetary policy and fiscal policy, and I want to toss out a caution about overstating the amount of fiscal policy stimulus that it's diminishing. 3 points here. Certainly, fiscal stimulus is far less than it was in 2020 and 2021. However, President Biden's infrastructure legislation of $1 trillion, that is starting to flow through the economy. We see it having a large impact on Q4 and Q1 in GDP, and that is going to continue to flow for several years. 100% of the spending goes directly into GDP, and fiscal analysis historically suggests that that comes with a higher multiplier than transfer payments. Secondly, of the $5 trillion in budget spending, deficit spending authority, $500 billion was federal grants to state and local governments. 100% of that was saved. Right now, state and local governments behind the Fed are the second largest holder of US Treasuries, about $750 billion more than pre-pandemic levels. That is another, 3% of GDP, and we know that'll be spent and will be stimulus. Even Social Security COLA added Medicare, Medicaid, SNAP programs. It all adds up to a tremendous increase in nominal disposable income.
Government spending is important for this purpose. If you think that the infrastructure spending is legitimately on public capital, and that's improving the productive capacity of the country, something we could definitely have a whole conference on. But if that's what you think is going on, I think that's a different animal than borrowing money and putting it directly into bank accounts of households. So that's one. On the state and local, I agree with you. One of the things that I've found in anecdotally in talking to people across the district and across the country is that state and local governments are flush. They have a lot of spending. So it's like you poured a lot of federal spending, you put it out to these state and local governments, but they don't really have the infrastructure to be able to spend it at that rate. And so it's trickling out. And I think that will come out over time. So I agree with that. COLA is also an issue, but I think the more immediate issue for monetary policy is the transfer payments, I think.
Hey there, Charlie Segular. We talk a lot about forward projections and trying to make all sorts of forward assumptions, and yet the Fed gets on a weekly basis data on M2 money supply. Yet we hardly hear about it, and it's in recent data. There's been nothing normal about it, and 2 years ago, data there was nothing normal about it. So I just want to sort of highlight a couple things from January 1 of 2020 through December 31st of 2021. Money supply grew by 40%, which was the highest 2-year growth on history. There may be something in the 1700s that Neil Ferguson may see, but in the data that I looked at, there's nothing. At the same time, bank deposits grew by 36%, by to the tune of about $4 trillion. Both money supply and bank deposits peaked at the same month last year, April of 2022, and they've both been in decline since. This is now there's a year-over-year decline in M2 and bank deposits, which is the first time that I've seen this has ever happened. Most recent data shows that M2 is declining by 4.1% annualized, which is an all-time low in terms of percentage growth. So just trying to sort through all this, and there's a lot of extremes going on here in these fluctuations, and I just wonder if these extreme gyrations reflect or are affecting financial and price stability, and is M2 something that the Fed should be looking at more closely?
Well,
I will say this about M2, that I come from the monetarist bank and sort of grew up as a monetarist, so I'm very sympathetic. It's been hard to relate money growth to inflation empirically. I think that the standard thinking around the St. Louis Fed anyway over the years has been that at low levels of inflation and low rates of money growth, there's just too much other noise going on in the economy. It's hard to relate money growth to inflation in that circumstance. Now here you had an outsized movement in M2, and sure enough, you got inflation right behind it. So maybe monetarism will be reinvigorated by this episode. I would also say, if you subscribe to this theory, that this bodes well for disinflation ahead, if that's the way you want to look at it.
Yeah, go ahead. Go ahead.
Yeah, I'd commend a recent piece by Peter Ireland in Forbes, or at least on their website, arguing that we need to relearn monetarism. It's a play on some senior official who said we unlearned it.
Okay, we have Bill Nelson and Andy and Krishna. Bill, now we got to stop. Bill.
Hi, Bill Nelson, Bank Policy Institute. So I have two questions for the panel. The first is, to what extent does the FOMC and the Fed bear some responsibility for the financial turmoil we've been experiencing, owing in large part to the sharp rise in interest rates that we've witnessed? I mean, I'll acknowledge up front that first and foremost, the problems were the responsibility of really awful bank risk management, and we learned a lot about regulation, improvements to regulation and supervision. But it's also true that a central bank that is behind the curve raises rates just as much, as one that's not behind the curve, but actually by more and more rapidly, and that financial stability consequences is one of the important reasons not to fall behind the curve. But it's worse than that. There was also, the Fed was actively communicating to the markets, that neutral policy was 2.5% at a time when inflation was running at 8%. So, for example, this is from the July 2022 FOMC meeting. This is Chair Powell. So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 2.25 to 2.5, and that's right in the range of what we think is neutral. And there were some commentators, and I was one of them, saying that's dangerous advice because it's going to cause, intermediate and longer term rates to be too low. And the second question, which is related to that, which is I'm curious from each of the panelists to know your current spot estimate of nominal neutral federal funds rate.
So let's go Andy and then Krishna. Andy and Krishna.
Well, first of all, just thanks a lot to John for organizing this conference. And I think this kind of forum is really important for the public to actually have a dialogue. One of the things that's been just very troubling to me the last several years is you look at the Bank of England, they've been facing lots of tough decisions, tough judgment calls, and there's been dissents on both sides. You can talk to Catherine Mann, she's brilliant. She's dissented from some of their decisions. She may be right or wrong, but she's got an independent point of view. And meanwhile, the FOMC has been kind of this unified, I think maybe Mickey said it earlier, kind of circling the wagons view. And I recognize, Jim, you've been courageous and brave over your career, as have Jeff and Charlie Plosser, right? To sometimes say, no, I don't agree with that. And sometimes you might be wrong, sometimes you might be right, but it takes some courage. And I just hope that going forward, that all of you will because you're going to be facing tough decisions. So I'm really excited that you're going to be a leader in this going forward. And I guess my question for you and Jim is, Jim kind of presented this thing of, well, maybe we're just at the very bottom of what do you call it? The range, the comfortable range, or the zone. Okay, in the zone. Okay, but the worry that I have is that what went wrong in the 70s was that in the end, the Fed got so far behind the curve, they had to tighten so much. We had a terrible recession, and it hit ordinary families really hard. And so it's urgent to find a way to bring inflation down without causing that kind of catastrophic damage to the real economy. And so, Phil, you mentioned the dual mandate. And so I'm just curious, for the two of you, thinking about risk management, where in that zone should we be? Should we be at the bottom, or maybe at the top, or somewhere in the middle? I mean, this comes back to this morning about the Taylor rule as a benchmark. So again, I really appreciate the two of you helping us to understand your views.
So Krishna, and then we have the response.
Thanks very much. Krishna Guha, Evercore Partners, formerly New York Fed. Quick comment and a quick question. Quick comment is, when we talk about the market and whether the market's misunderstanding things, I think it's illustrative to point out that using the Lacker-Plosser sort of benchmark, were the world to evolve along the lines envisaged in the FOMC's SEP, then in fact, according to standard Taylor rule specifications, Fed funds rate should be somewhere between 2.5 and 3 at the end of 2024. That's what your first slide showed. And so it's not necessarily obvious that the market is wildly mispriced. The market may, however, be too optimistic about the prospects of achieving that inflation path, which you rightly illustrated yourselves in the second set of slides. My question has to do with the multiple forms of tightening that are taking place at the moment. So we have 3 forms of tightening underway. There's monetary tightening through the classic interest rate channel, there's balance sheet tightening, and there's some hard to quantify credit tightening taking place. So if we were to try to integrate this into a Taylor type rule, would it be reasonable to enter in some additional terms for those other forms of tightening? And if not, how should we integrate these into our thinking?
These last 3 questions, to me, are closely related. Okay, one was about trying to assess the impact of, let's call it the credit shock. Okay, the one prior to that had to do with balancing the dual mandate. One before that was from Bill was asking about what was the neutral rate. Okay, so in my mind, the questions are kind of all related to one another in some way, and I think that is what makes monetary policy quite challenging, because I do take the dual mandate very seriously. Those of you who may know something about my background in terms of my scholarship, I've written extensively on poverty and inequality. I'm from a neighborhood in Washington, D.C., where I've seen very disparate outcomes for people in this society. So I care very much about how the labor market performs, because for most people in the U.S. economy, their standing in the labor market will very much determine their station in life. And so that's something I'm very mindful of. But I also am aware that inflation is the most insidious of social diseases. And so it's important to try to get it down so that people can go about their lives in a way where inflation is in the background. So what makes saying what the neutral rate is in this environment so difficult is that we have multiple things going on, okay? We do have the credit shock and its impact, and that can impact your thinking. So I think it's a matter of public record that for the banking shocks occurred, I would guess, and Bill, Jim, please correct me, people on the FOMC had one view of what that neutral rate might have been, or the terminal rate, if you want to think about it in that way. And the shocks may have had the credit shock may have had some impact on their thinking. So whether or not anyone wrote down a Taylor rule that included the impact of the credit tightening or not, we can't say for sure, but I think in terms of policymakers thinking, it certainly weighs in. So I don't have a definite answer to these 3 questions, but I want you to know that these are the considerations that we're all trying to balance as we're looking or thinking about the appropriate setting of the main policy rate.
Thank you. Jeff, well, then we have to stop.
Yeah. So to Bill Nelson, we did cite the Powell statement you quoted in our paper. noted that a month and a half later in August, John Williams, head of the New York Fed, gave an extended interview to the Wall Street Journal where he lays out the right way to think about the neutral rate. Neutral rate, it depends on how you define it, like Fiscal or the SEP. Those are two different questions. Is the market off base? The question is like, what's going to get inflation down to where it is, right? Where it's going in the SEP. And the Taylor rule says, well, given what we've seen now, we're not there. It's sort of like a miracle happens in the next 3 quarters or 2 quarters. Now, the credit tightening point is interesting. So the Taylor rule summarizes, given inflation and unemployment, here's where the rate should be. Now, times where the Feds had to tighten to reduce inflation, it's almost always been associated with some credit tightening, virtually every time, right? So you would only want to adjust the Taylor rule for credit tightening. You would only want to forego rate increases that you would otherwise undertake on the base because of the presence of credit tightening if you thought the credit tightening was worse than it was typically in the past at times like 1990, early 90s, 2001, 82, right? So it doesn't seem to me like that's warranted now. So I don't think you add a term for it here.
I think we have to stop. Is that okay? Maybe last word for Jim. Go ahead.
Okay, so I agree with Philip Jefferson. The unemployment rate is very low, 50-year low. The inflation tax is high. This hurts the lowest segment of the population, of the income distribution, the hardest. They have less ability to adjust to the inflation. So I think that's our opportunity to get inflation down now, if we can, get rid of the inflation tax. And while the labor market is strong, is the market, Krishna Guha, I agree, the market's optimistic. They're not necessarily wrong. I like to interpret that as they have a lot of confidence in the FOMC. I think there are multiple forms of tightening going on. You have to put that in a model. You can't just put that in your Taylor rule. And then on Bill Nelson, financial stability, did the Fed cause the financial turmoil? I said contribute. I think we did communicate fairly effectively that we were going to raise rates quickly. And I do think, by and large, the financial sector agreed that we were going to have to do this. They saw a lot of inflation. They agreed that we were going to have to go up quickly. You just can't expect every entity in the whole country to adjust appropriately, and so some probably are going to get burned on this. But I think overall, I think it's been pretty good. I will say, financial stress metrics are actually still quite low. So we're not in a situation that we were in March, April of 2020, and we're certainly not in a situation that we were in 2008. So far, so good. Hopefully we'll get good results out of this.
Okay, thank you, panel.